It's not every day you hear about a tech giant emerging from Romania, but UiPath did just that.
Yeah.
Became the country's first tech unicorn.
Right.
Now they're a major player in enterprise automation and AI, and they've got this really bold vision, agentic AI. Sounds pretty futuristic.
It does. And, well, today we're diving deep into UiPath, that's ticker symbol PATH. We've got a whole stack of research here, and we're going to see if this company might align with, value investing principles.
Exactly. It's fascinating right off the bat, isn't it? Their ambition.
It really is. I mean, starting in Bucharest, outsourcing, then this really smart pivot to robotic process automation, RPA, around 2012. That's what really launched them globally.
Yeah, leader status, Romania's first unicorn. Quite the story.
And now they're aiming for this next level, this agentic automation. So this deep dive, it's based on a pretty comprehensive research report from May 11th, 2025. We're going to look at everything.
Everything meaning?
Well, the business model, we'll even look at it through a sort of Buffett lens. Then the leadership, financials, how the market sees them, ownership, risks, the whole picture, really, as of that date.
So think of this as your shortcut to getting really informed on UiPath. Our mission for you, the listener, is that by the end, you'll have a solid grasp of their business, the potential, the challenges, without feeling buried in data. We want those aha moments. So the plan is, first half, we nail down the fundamentals. Understanding the business itself, checking out the management, and assessing their financial health.
And looking at that first half through that value investing perspective, we're really trying to get a handle on the intrinsic value, right? You need to understand the operations, the leadership quality, the financial strength before you even think about the stock price.
Makes sense. Then, second half.
Second half, we zoom out. Market sentiment, who the big shareholders are, that ownership structure we need to understand, and a good look at the risks. Then we'll wrap it all up. Key takeaways.
Sounds good. Let's jump in.
Okay, let's start with the foundation, understanding the business. As the report highlights, that origin is unique. Founded in Bucharest, 2005, as desk over tech outsourcing. But that pivot around 2012-2013 to RPA, that was the key move.
Absolutely. That led to global leadership, the unicorn status, the IPO in April 2021, and now headquartered in New York. Quite a journey.
And their mission now is really focused on the future. Shaping the future of agentic automation, aiming to accelerate human achievement. It's all about this AI-enhanced platform.
This agentic automation. Can you break that down a bit? What does it actually mean in practice?
Yeah, think of it like giving software or robots more autonomy. Instead of just following rigid pre-programmed steps, these agents, powered by AI, can understand goals, make decisions, and handle more complex, dynamic processes with less direct human input. It's about AI agents, software robots, and humans all collaborating more effectively.
Okay, got it. So AI making the robots smarter and more independent.
Exactly. And their strategic direction is heavily focused on this. Deep AI integration is the name of the game. They want AI executing complex stuff with minimal human handholding.
And that acquisition, Peak AI.
Right. Peak AI Limited, March 2025. That was a strategic move to bring in specialized AI agents. They started with retail and manufacturing. It shows they understand that, generic AI isn't always enough. You need industry-specific smarts sometimes.
Okay, so what's actually in the UiPath platform?
Yeah.
Sounds like a whole suite of tools.
It is. It covers the whole automation lifecycle. First, you discover opportunities. Tools like process mining analyze workflows. Task mining looks at what individual employees do, finding those automation sweet spots.
Right, finding where the bots can help.
Then you automate. That's using their studio tools, low-code options, integrating AI, generative AI included, to actually build the automations.
Build the bots.
And finally, you operate. This is about managing these automations at scale. Governance, security, monitoring how they're doing, real-time analytics, all under this umbrella of agentic AI. So discover, automate, operate. Those are the pillars.
Okay, that makes sense. Like that hospital example you mentioned, Discover finds the patient onboarding mess, automate builds the data entry bot, operate keeps it running smoothly.
Precisely.
So how does this all translate into money for UiPath? What are the revenue streams?
Looking at their fiscal year 2025 numbers, 3 main streams. First, licenses. That brought in $587.2 million, but interestingly, it was actually down 6% year over year.
Down, okay.
Second, and this is the big one and the fast-growing one, subscription services. This is their SaaS stuff. Support, $801.9 million, up a healthy 23%.
That's more like it.
And lastly, professional services and other consulting, training, things like that, $40.6 million, up 10%. But the key trend here is that shift towards SaaS. Their annualized recurring revenue, ARR, hit $1.666 billion as of January 31st, 2025.
Right, that recurring revenue is what investors often love to see. Predictability.
Exactly.
So who's paying for all this? Who are their main customers?
They're targeting large enterprises, really across the board: healthcare, finance, public sector, telecom, you name it. They had about 10,750 customers total early in 2025.
Okay.
But a really important chunk, 2,292 of those, were contributing over $100,000 in ARR each. So those are the big accounts making serious investments.
And the core appeal for these big companies. Why UiPath?
Fundamentally, it's about efficiency and productivity. Boosting scalability, making customer experiences better because things run faster, saving costs by automating repetitive tasks, and improving accuracy, fewer human errors.
Makes sense.
And increasingly, the focus is on enabling that human-AI robot collaboration to tackle even bigger, more complex problems.
Now, you flagged that interesting revenue trend, subscriptions up, licenses down. What's going on there? Any ideas?
Yeah, that's a really crucial point for analysis. Strong subscription growth is great, obviously. But that 6% dip in licenses, it raises questions.
Like what?
Well, are they struggling to land new customers for those initial, maybe on-premise deployments? Is the traditional RPA license market getting saturated, or is competition just heating up?
Could be any of those.
And some analysts pointed out this potential growing gap between ARR and revenues, possibly due to things like non-recurring rebates or one-time discounts. It just means you have to look closely at how sustainable that ARR figure really is.
Right, got to read the fine print. So this big push into agentic AI, necessary gamble, risky.
Probably a bit of both, honestly. Strategically, they have to go there, right? With AI taking over everything. But it's a huge undertaking. R&D spending shot up $380.7 million in FY25. That's over 26% of revenue.
Wow, that's a big chunk.
It is. And there's execution risk. The AI space is incredibly competitive. Tech giants, nimble startups. UiPath needs to carve out a clear advantage.
And what about offering that whole end-to-end platform? Is that purely a strength, or does it make things complicated?
Well, it's a double-edged sword, potentially. On one hand, having everything from discovery to operation in one suite, that can create sticky customers. Harder to switch if you're deeply embedded.
Wait, the ecosystem lock-in.
But it also means complexity. User experience and seamless integration are huge, and RPA adoption historically hit bumps with integration challenges. So UiPath has to ensure their big platform doesn't become a big headache for users.
Okay, makes sense.
Yeah.
Let's pivot then. Let's talk about the people running the show. What does the research tell us about UiPath's management?
Well, the big news is Daniel Dines, the founder, is back as CEO. He returned in May 2024 after some time as Chief Innovation Officer.
The original visionary.
Exactly. He's known for that visionary-style aggressive growth. They used to call it the Genghis Khan strategy internally, apparently. His return suggests maybe they felt they needed that original spark again.
Interesting. Who else is key?
Ashim Gupta. He's the CFO, but also took on the COO role in September 2024. So a crucial figure in finance and operations. Now, it's worth noting, both Dines and Gupta sold some shares on May 1st, 2025.
Insider sales. Always catches the eye.
It does. Could be perfectly normal reasons, pre-planned sales, whatever, but the timing around strategic shifts means investors will watch that.
Any other changes? Board members?
Yeah, Layla Sturdy left the board in early May 2025. She'd been there since 2021. The company said it was amicable, but again, a board departure near a CEO change. Sometimes hints at strategic discussions or shifts. They also brought on S. Somasegar and Karen and Terrell in the last couple of years, so the board's evolving.
And how have they handled external stuff like the Ukraine crisis?
That seems to have been handled well. They used a platform called Good Today for employee donations, matched them, significant contribution. Their foundation set up funds too. It reflects positively on their culture, maybe ties into that humble company value they list.
Okay, so summing up the leadership picture.
Dines' back is potentially huge. His vision drove them early on. But you've got the insider sales to keep an eye on. The positive crisis response is good for culture perception. Sturdy's departure. Just a point to note.
Got it. Now, corporate governance. How's UiPath set up there? Any red flags for shareholders?
Well, the specifics on board committees, compensation, that's usually in the proxy statement, and the mid-2025 one wasn't available for this research. We do know they offer governance tools to their customers for automation, and they talk about being committed to good governance internally.
Right.
But there was that GDPR fine. €70,000 against their Romanian arm in July 2023. Data breach on their Academy platform affected maybe 600,000 users. That definitely highlights a past issue with data security.
Yeah, for a data-heavy platform going deeper into AI, that's not ideal.
Exactly. Security is paramount. On AI ethics, management does acknowledge the need for human oversight. Now, the other big governance piece is the dual-class stock structure.
Ah, yes. The Class A, Class B split.
Right. Class A shares, the ones publicly traded, get 1 vote. Class B shares held by founders, early investors, Dines included, get 35 votes per share.
35. Wow.
Yeah, it concentrates voting power massively. Published shareholders have very limited influence on big decisions. It's a structure some value investors like Buffett famously dislike because it's not equal voting rights. You're essentially placing a lot of trust in those controlling shareholders.
Okay. Definitely something for potential investors to understand. Let's move on to how they're spending their money. Capital allocation.
Big focus on R&D, especially for that agentic roadmap in AI. We mentioned the $380.7 million in FY25, over 26% of revenue. They're also doing strategic acquisitions like Peak AI for those specialized capabilities.
And share buybacks.
Yes, quite active there. They had a $500 million program that finished in March 2025, then authorized another $500 million in August 2024, which is ongoing. In FY25 alone, they bought back nearly 32 million shares for about $390 million.
So they're spending significant cash buying their own stock.
They are, and they did buybacks before FY25 and after it closed, too. As of Jan 31st, 2025, they still had over $500 million authorized for more repurchases. Oh, and no dividends. Typical for a tech growth company.
Buying back shares while GAAP unprofitable and growth is slowing. What's the logic?
It does raise questions, right? Maybe management thinks the stock is cheap. That aligns with value thinking buy low. But there's an opportunity cost. Could that cash go to more R&D sales, accelerating profitability?
Right.
Plus, the Peak AI acquisition, while strategic, adds integration risk. And that massive R&D spend has to translate into real competitive advantages. It's crucial, but the payoff isn't guaranteed.
Okay, let's get into the numbers. Financial health. What does the history tell us?
Looking back, fiscal 23 to 25, the big story is slowing revenue growth. It went from 48% in FY23 down to 23% in FY24 and then just 9% in FY25.
Oh, 48 down to 9. That's quite a deceleration.
It is. And remember that license revenue declined 6% in FY25. Subscriptions were strong, up 23%, which is good. Gross margins are still high, around 82-83%, but dipped slightly in FY25.
What about profitability?
They're narrowing GAAP operating losses down from over $348 million to about $162 million in FY25. And on a non-GAAP basis, they actually posted significant operating income, $241 million in FY25. Net losses also narrowed.
Non-GAAP positive, but GAAP still negative.
Right. And AR growth is slowing to 30% down to 14%. One clear positive is net cash flow from operations is increasing.
So that growth slowdown really is the headline concern here.
Absolutely. For a company often valued on growth, that's a major red flag for investors. And while non-GAAP profit is good, achieved through cost control, you have to see the gap to gap. Stock-based compensation was huge, over $358 million in FY25. That's a real cost dilution.
Yeah, non-GAAP can hide things.
So the license decline, the slowing AR growth, need close watching. And the data we had lacked detailed geographic revenue breakdown, which is a bit of a gap.
What about the balance sheet itself? Any worries there?
No, actually, the balance sheet looked pretty strong as of Jan 31st, 2025. About $1.25 billion in cash, equivalents, marketable securities, and importantly, no long-term debt.
Good. Healthy cash position.
Yep. Deferred revenue is also strong, over $700 million, giving some future visibility. Working capital looked good. Current ratio solid at 2.29. Some goodwill on the books, likely from acquisitions. Overall, a strong balance sheet gives them flexibility.
Okay, flexibility is good. How about return on invested capital, ROIC? Are they generating good returns?
Well, it's tricky because of the lack of consistent GAAP profit. GAAP ROIC for FY25 was negative, around minus 10%.
Great.
If you estimate using non-GAAP numbers and a tax rate, it looks better, maybe around 11%. But the main point is they haven't shown that consistent high GAAP ROIC that value investors really look for. Future capital decisions are key here.
Got it. And looking ahead, what's their guidance for this year, FY26?
Their outlook was pretty conservative. Revenue guidance is $1.525 to $1.53 billion. That's only about 7% growth year over year, and it was below what analysts were expecting.
Only 7%, wow.
Yeah. ARR guidance is around 9 to 9.3% growth. They do expect non-GAAP operating income to be around $270 million, margin around 17.6%. Management blamed macroeconomic uncertainty, especially U.S. public sector, and also U.S. trade policies, tariffs.
So continued significant deceleration.
That's the major takeaway from the guidance. Big concern for investors. They're focused on non-GAAP profit through cost control, but that needs careful balancing with investing for future growth.
Okay, let's shift gears. Second half. How is the market actually feeling about UiPath right now? Analyst sentiment.
The general vibe from Wall Street as of May 2025, it's pretty much a hold or neutral. Looking across different sources, Zacks, Fintel, Wall Street the consensus leans that way.
Any price targets?
Yeah, but they're kind of all over the place. The average tends to be in the $11 and $12.50 range, though you see some outliers higher, like Public.com's average around $22. But most targets seem clustered between $10 and maybe $15 or $18 at the high end.
That wide range suggests uncertainty.
Definitely. We saw Mizuho cut their target to $12, staying neutral. FBN kept a buy rating but lowered their target to $13. The commentary reflects this tension. Strong tech, RPA leadership, AI potential. But slowing growth, falling retention metrics, macro worries, no GAAP profit path clarity, AI competition. Recent target cuts really highlight those concerns.
Okay, mixed bag, leaning cautious. What about the big money? Institutional investors.
Institutions hold a lot, about 72% of the shares as of May 2025. Around 342 million shares, 744 institutions. Big names include Vanguard, BlackRock, Senvest. ARK was a major holder too.
ARK, Kathy Wood's firm.
That's the one. But interestingly, ARK significantly reduced its stake in early 2025, cut it by over half. Vanguard, on the other hand, increased its holdings.
ARK pulling back. That's notable for a growth-focused investor.
It could signal waning confidence, maybe due to the slowing growth or worries about AI competition. Definitely something to note.
And what about insiders? We mentioned the CEO and CFO selling.
Right. Daniel Dines sold 45,000 shares. Ashim Gupta sold 99,300 shares, both on May 1st, 2025. They still hold a lot of stock, but sales during this kind of transition and slowdown. Some investors might see that negatively, regardless of the personal reasons.
Fair enough. And lastly, on sentiment, short interest. Many betting against Path.
It's moderately high, around 38 to 43 million shares shorted as of May 2025. That's roughly 9–10% of the public float.
Okay, not insignificant.
No. Days to cover were around 5.5 to 6.5 days. There were also spikes in off-exchange short volume sometimes. It points to a decent amount of bearish sentiment, likely driven by all those concerns we've discussed. Growth, AI pivot, gap losses, macro stuff. And high short interest can mean more stock price volatility.
Okay, let's quickly revisit that ownership structure, the dual-class shares. Remind us of the key implication for regular investors.
Sure. Class A shares get 1 vote. Class B shares get 35 votes. That means founders, early investors, insiders like Dines have overwhelming control.
So public shareholders, Class A holders,
Yeah.
their influence is pretty limited.
Very limited on big decisions, electing directors, major strategy shifts. You're really putting your trust in the judgment and alignment of those controlling shareholders. As we said, not ideal for investors who prefer equal voting rights.
All right, let's look at the potential bumps in the road. Risks. What are the big ones facing UiPath?
You can think of this like the weaknesses and threats part of a SWOT analysis. Competition is fierce. You've got big enterprise platforms adding automation, traditional software vendors getting into AI, nimble AI startups, other RPA vendors. It's crowded.
Okay, competition is key. What else?
Sustaining growth and actually achieving consistent GAAP profitability, that's a big one given the slowdown. They're heavily reliant on innovation, especially making that AI vision pay off. Customer retention and expansion is crucial, and that declining DBNRR metric is a concern.
DBNRR.
Dollar-based net retention rate. Basically, how much more or less existing customers are spending compared to the previous year. If it's falling, existing customers aren't expanding their spend as quickly or maybe even reducing it.
Got it. Other operational risks.
Long sales cycles for enterprise deals. Getting the go-to-market strategy right. Attracting and keeping top tech talent always tough. And of course, security breaches and data privacy, like that GDPR fine reminded us.
And technologically, with AI moving so fast.
Huge risk there. Rapid AI advancements could make parts of their current tech less relevant. Competitors with deeper AI pockets or expertise could leapfrog them. They have to keep pace, constantly.
What about regulations?
That's getting more complex too. Data privacy laws like GDPR, CCPA, China's PIPL, They're already complex. And now AI regulations are emerging, the EU AI Act, US initiatives. That means more compliance hurdles, potentially higher costs. Plus, their software needs to help clients in regulated industries stay compliant.
And tariffs. You mentioned management was concerned.
Yeah, they flagged US trade policies. While UiPath is mostly software, tariffs on IT hardware can indirectly hit them, maybe slightly higher internal costs. But the bigger risk is if tariffs make hardware more expensive for their customers.
Ah, squeezing customer budgets.
Exactly. If companies have to spend more on hardware, they might delay or cut back on software spending, including automation projects. Those 2025 tariffs on Chinese goods, steel, aluminum, they ripple through the IT sector.
And just the general economic climate.
That's the other big macro headwind. Management said uncertainty is hitting budgets, deal timing, especially in the U.S. public sector, recession fears, inflation, interest rates, geopolitics. All that stuff can make businesses cautious about big IT spends. UiPath isn't immune.
Okay, wow. We've definitely covered a lot of ground. Let's try to synthesize this. What's the concluding assessment of UiPath as, say, a value investment right now?
Well, summing it up, there are strengths, right? The core business is fairly understandable. They have some kind of competitive moat in automation, though its durability is debatable. Strong balance sheet, focused management, but big weaknesses and risks too. That moat's durability against AI competition is a huge question. Still no consistent GAAP profit. Growth has slowed way down. The valuation as of May 2025 didn't scream bargain for value folks. Plus external headwinds and that dual-class governance structure.
So the bottom line for someone listening may be considering investing.
Based on this snapshot in time, May 2025, UiPath looks more like a speculative long-term growth play than a classic value investment. The market potential is there, sure, but there's just a lot of uncertainty around future growth, profitability, and how they'll fare in this super competitive AI race.
So for current holders.
If you already own it, have a high risk tolerance, and really believe in the long-term vision, maybe you hold.
And for new investors focused on value.
Probably wise to wait. Wait for more proof of sustainable, profitable growth. Wait for clearer signs of a strong, defensible AI advantage. And wait for a valuation that offers a better margin of safety.
Okay. Now, before we wrap, that surprise factor I mentioned. This deep dive was thorough, based on the report. But there's one crucial element for their AI future that wasn't really detailed.
Oh, what's that?
The developer community. The ecosystem around UiPath. Who's actually building all these automations and AI agents? How engaged and innovative is that community? That's incredibly important for a platform company, especially in AI.
That is an excellent point. A vibrant developer community can be a massive, sometimes overlooked, competitive advantage. Drives innovation, adoption.
Exactly. But that, perhaps, is a deep dive for another time. So, listener, turning it over to you. What stood out most to you from our discussion on UiPath? What questions are still lingering in your mind?
Yeah, take a moment to think about what resonated, what concerns you, and what else you might want to explore for your own understanding.
Thanks so much for joining us for this deep dive into UiPath. If you found this valuable and want more analyses like this, definitely subscribe to the Stock Analytics AI YouTube channel.
And just our standard disclaimer. This analysis is based on information available as of May 11th, 2025. It's our interpretation, not financial advice. AI tools might have assisted in the research. Please, always do your own thorough homework and talk to a qualified financial advisor before making any investment decisions. You can find the sources we use listed in the description.
And one final thought to leave you with. As AI keeps weaving itself into enterprise automation, maybe the real power isn't just in the algorithms themselves, but in the human ingenuity that builds, adapts, and applies them. How effectively can UiPath foster that human element going forward?